Welcome, everyone. This is really exciting for us. Stuart, myself, Brian, and Jeff all came together probably 4 or 5 weeks ago, or actually a while back now, and we talked about ideas to be able to create a group of that really supported business owners that were looking to grow within the Louisville community. And so what we decided to do was to create what's known as a small business summit, this is our inaugural meeting where we pretty much bring speakers and together to talk about topics that are relevant to business owners and entrepreneurs to help them grow and exceed and grow within the Louisville community. So today we're really excited to host 2 speakers, actually, Stuart Alexander from Highlands Law Group, and then we have Strothman, who's also going to be talking about the PPP Forgiveness program. So what's generally going to happen as far as the structure is concerned is we're going to first start off, Stuart's going to kind of touch on some of the OSHA guidelines to getting back to work in a safe manner, given the current situation we find ourselves in. And then Strothman's going to have their presentation on the PPP Forgiveness program, and then we'll open it up to Q&A right afterwards. So you guys will have your chance to ask whatever questions you guys have. Sound good? Awesome. Well, I guess, Stuart, do you want to go ahead and
what I'll do is I'll do the shared screen thing, and then I hope to, Okay, can you see my little PowerPoint thing?
Yep.
Okay, good. Well, good evening, everybody. Thanks for coming out tonight. I know this is the happy hour, so feel free to do whatever you need to do at this time of day. My name's Stuart Alexander. I'm a lawyer. I work in the business area, small businesses particularly, and I do a lot of employment law. Really, as employers know, or businesses that have employees know, really employment issues pop up as frequently, or if not more frequently than anything else. I'm going to take about 10 or 15 minutes to talk about 3 separate areas, and then I'm looking forward to hearing our colleagues' PPP discussion. 3 things I'm going to try to cover today. First of all is the unemployment or employment situation, depending on your point of view. That's a mess, as you all know. The second issue is going to be the health and safety connection, at least from the employer standpoint, what you have to worry about with regard to your employees. And then the third is risks that may be present towards third parties who are not your employees. For example, vendors who come onto the premises, customers who walk in the door, whatever, salespeople, whatever. And so that's sort of a different issue altogether. So let's sort of get right into it with the employment and unemployment issues. Nothing's really changed because of COVID with regard to the basic rule. The at-will employment thing is still alive in every state. That means that you can hire and fire at will. That means that you can unilaterally set the terms and conditions of employment. Likewise, the employee doesn't have to work for you. They can always quit. The only limitations to that come with like discrimination laws. If you're motivated by illegal motivation, then that's a different story. But at-will employment is the basic idea. Unemployment, of course, that's a state law concept. What's going to happen with regard to employers' unemployment accounts and how they get charged, I can only imagine. It's not going to be pretty. But what we need to remember is that unemployment claims are still going to be defended like they always have. So for example, when you're an employer and you lay somebody off, or they quit for that matter, and then they file an unemployment claim, the defenses that have always been available to the employer are still available. Stuff like misconduct, voluntary quit, a violation of a work rule, damage to company property, those sorts of things, they're still defenses. And so the process, of course, is that there's a claim, and then a notice gets sent to the employer. Employer can contest that claim. Ultimately, there is a hearing with a hearing officer on the phone. Hearing officer makes a decision. there are some appeal levels that generally don't matter. It's that phone hearing that really matters. So that's the way the process worked and still works, although it isn't working very well currently. So, one of the things that COVID has affected are some of the employment policies. For example, I've had clients talk about how they want to make sure to pay people properly under the wage and hour rules. And people are working remotely. They're not always sure that people are working, all of that sort of thing. So you really probably also ought to look at the employment policies as well. And I should say that, for example, if you decide to pay somebody less, you can do that. Again, they can quit. But I would say that if you're paying them substantially less than say 25% of what you were paying them before, that may actually be an involuntary separation as far as the unemployment people are concerned, and you, the employer, may lose that one if you reduce somebody's wages by, say, more than 20%. So the second area really has to do with health and safety. There are really two areas there. One of them is OSHA, the other is workers' compensation. And this is looking at the employer's responsibilities for the employees as opposed to someone who is not an employee. So the way this works is OSHA, of course, is a federal health and safety standards act. There are a lot of very specific standards for some things in the OSHA regulatory world. For example, fall protection, for example, the conduction of electrical energy. These things have very specific, and a lot of times they adopt industry standards. So, there are very specific rules for some things, but where OSHA gets its jurisdiction for COVID, for example, comes from something called the General Duties Clause. This may sound cynical. I defend OSHA claims for employers, but if OSHA wants to get you and they can't find something specific to tag you for, they'll trot out the General Duty Clause. And it basically says that you, the employer, will provide a safe place of work, and necessarily pretty vague. Independent contractors, again, if you're an employer and you've got independent contractors, you need to take a hard look at them. OSHA a lot of times takes the position that those independent contractors, you, the employer, have a responsibility over their health and safety as well. And that's a real slippery area. And of course, the second part of this is workers' comp. So if someone, your employee, comes, has a work-related condition, whether it's an injury or an occupational disease, they could, in theory, get workers' compensation for anything arising out of their work. Well, of course, it's pretty darn tough for somebody to say, hey, I got COVID at work, or to be able to prove it. And so the governor, and this all may change because, of course, the governor and the attorney general were before the Kentucky Supreme Court today arguing about the governor's emergency regulations in general. But for right now, there was an emergency order by the governor that makes it presumed that if you have work, that the COVID is work related, so that the worker may not have to prove that connection, that causation connection. That's a concern, and that may not last long, but that's the way it is right now. And of course, it also affects if you're big enough to have coverage by the FMLA, which is the Family and Medical Leave Act. Obviously, there's some implications there. The Americans with Disabilities Act also, when somebody's coming back to work, they've had COVID, they are regarded as having COVID, might be some ADA questions, but those are pretty complicated areas. Don't have time for that tonight. And then finally, there's the risk, if any, that the employer has for non-employees, vendors, people that are coming on to your workplace. And there again, it would be pretty hard for somebody to prove that they got COVID from your workplace, as opposed to, at church or at the soccer game, or the kid brought it home from school, whatever. But they would have to prove that. And secondly, they'd have to prove that you were negligent. And it's hard for me to imagine that you would be negligent if you follow the cleaning protocols, whatever, signage, social distancing, temperature screenings, masks, cleaning protocols, all of that. The more of that you do, the less likely it is that you're going to have any risk from a third party. And then, of course, the bottom line there is some of that risk may be covered by liability insurance. And that's an issue that I'd really like to talk to an insurance broker about, because I'm not absolutely certain that the language in most policies provide much coverage, but that's a possibility. So those are really the three areas I want to cover. A quick war story, just to talk about how you might be a little more proactive. I represent a large nonprofit, and they have a fair number of employees. And of course, they've, like everybody else, have been struggling through this COVID thing. They had to lay a bunch of people off, but they kept a number of people and they had work available. And one of the people that they kept indicated that she just didn't feel comfortable, so she quit. And then she went and filed an OSHA complaint and said that she didn't feel comfortable at work, didn't think they were doing it right. And then she filed an unemployment claim, claiming that she was forced out of the job because they weren't doing it right, et cetera, et cetera. So what happens then is OSHA comes over and they will do an audit, or at least they do an inspection of the premises. And they did. They came in and they looked at everything, and they basically told our people orally that this is the cleanest, most compliant workplace we've ever seen with regard to COVID. And then they put that in writing. So my client then used that written description from the OSHA people in the unemployment claim to say, hey, we're doing everything right. She has no basis for this charge that we forced her out because we're doing things that are unsafe. So at any rate, that's how it arises. And I'm happy to answer any questions you all may have. And that's all I have tonight. Thanks for being here.
Awesome. Thanks so much, Stuart. What we'll go ahead and do is, if you have some questions regarding that, go ahead and put them in the chat box and we'll address them at the end of the meeting. We'll do it all at once in the Q&A session. Awesome. So Stuart, you want to go ahead and unshare your screen real quick?
Yeah.
Just if you go down to the bottom, there should be a option to,
stop sharing.
I think, yeah, there you go. There we go. All righty. Well, thanks for that great presentation. I think it's provided a lot of value to people. So, so next up, it looks like Chantelle's already sharing the screen. So great. I'd like to go ahead and introduce Strothman Co, who's going to be talking about PPP loan forgiveness. You want to take it away? Is it Chantelle?
No, it's Joyce. Yeah, we're here.
Joyce.
We just had to unmute. Sorry.
No worries.
Yes, thank you all so much for inviting us to the inaugural summit meeting tonight. Strothman Company CPAs, we are really big on small to medium-sized businesses, especially the team that you have here tonight. I'm Joyce Smith. Matt Hagan is with us, and so is Chantelle Engel. We're all in the Strothman Middletown office, and we specialize in tax and related services, and we're part of the professional services team. And you've asked us to speak tonight about PPP loans and loan forgiveness and loan taxability. So that's what we're going to do for you. There were about 5 million PPP loans issued. And just to give you an idea of the dollar amounts of them, about 86% of those loans were individually under $150,000. If you move up to under $350,000, about 94% of those loans were under $350,000. So I think that gives you an idea that there were a lot of loans for small business people out there in this PPP program. The loan application process is now closed as of August the 8th. So on June the 5th, the PPP Flexibility Act was signed into law, and it modifies a lot of the forgiveness provisions of PPP loans that we had initially. And I think really it was done to try to allow as many businesses as possible to get as much forgiveness as they could. I think these modifications were put in with that specifically in mind. So one of the modifications was on the covered period. Your covered period is that it begins on the date that the lender has given you the loan. So that's when it starts. Initially, we only had an 8-week covered period. So if you had a loan that was issued before June the 5th, you could still elect for that 8-week covered period. But now the covered period for all loans is 24 weeks, regardless of your date of issue. So if your loans were issued on or after June the 5th, it's 24 weeks. If you had a loan before June the 5th, you can still elect 8 weeks, but most likely you're going to want to do 24 weeks unless you're sure that you're going to be able to get 100% forgiveness in that 8-week period of time when you spent your PPP funds. If you got a loan late in the period, so since it finished on August the 8th, let's say you got your loan real close to the end of the deadline. If your 24-week period goes into January of next year, you have to stop at December 31st. So for instance, in that case, maybe your covered period for your expenses is only 22 weeks long. So just remember that if you got a loan in that August date, that August period of time, that most likely you may not have an entire 24-week period to spend your money. There was a modification of the rehire rule. Initially, if we had a reduction of our FTEs or we had a reduction of our wages, we were going to have to try to cure that by June the 30th. But with the Flexibility Act, even if our covered period ends before December 31st, we still have the ability to cure that by hiring people back or increasing our wages by the end of December. We also had a modification of the maturity date. If you had a loan that was issued before June the 5th, you have a 2-year maturity date. If your loan was issued on or after June the 5th, you have a 5-year period of time if you don't have 100% forgiveness to pay that back. And lenders are permitted to, but they don't have to extend that period to 5 years. So if you feel like you're not going to be able to make a 2-year repayment if you are not 100% forgiven in your loan, our suggestion would be go to your lender and see what you can do about that. There's also the payment deferral modification. It was that if you thought you were going to have to repay, you were going to have to do that at the end of your covered period, but now you're allowed to wait until the SBA remits back to the lender what your loan forgiveness amount is. If for some reason you would choose not to apply for loan forgiveness, you have 10 months after the end of your covered period before you would have to start repaying. So basically what this means is at the end of your covered period, so if you choose 24 weeks, your loan date starts your covered period, 24 weeks ends that, you have 10 months after the end of that covered period to apply for forgiveness of your loan. I think probably the biggest modification that's going to help everybody is what's this called the 60-40 rule. 60% of your PPP funds, at least 60%, needs to be spent on payroll costs and other related benefits. And you can spend the other 40% on other allowable PPP expenses. And when Matt goes through his section, he's going to give you some definition of both payroll costs and those other allowable expenses. Initially, we were going to have to spend 75% of our payroll, of our funds on payroll and 25% on other costs, but that's been eliminated. So anybody, including if you had your loan before June the 5th, you're under the 60-40 rule now, 60% payroll, 40% other allowable costs. The Flexibility Act also gave us a couple more safe harbors related to payroll. One of them is if you lose employees that you had on February 15th and you can't rehire them, that's their choice. You've gone out to them, you've tried to rehire them, they don't want to come back, and you're unable to hire someone with similar qualifications for that position before December 31st, you have a safe harbor that basically says you tried to rehire those people. You have to document that, and you're going to have to be able to show that you did make efforts to do that, but you don't have to reduce your FTEs if you meet this safe harbor requirement. Now, what does that mean? That means that when you get to your payroll part, and if they say, did you have the same number of employees, and you say, no, but I've got the safe harbor, you don't have to repay. It's not like a proration of your payroll or a proration of your FTEs when you're applying for loan forgiveness. The second safe harbor that came out of the Flexibility Act deals with situations where, because of compliance with CDC or OSHA or HHS requirements, you just cannot get your level of activity back in your business. You can't social distance, you can't meet standards for sanitation. There's other things that you were not able to comply with COVID-19 related. If you can't return to your same level of activity for FTEs, and you can show that this safe harbor number 2, that you meet that same type thing again, you don't have to do any kind of proration of your FTEs when you're doing your loan forgiveness application. So I think those are pretty important, because I think there's going to be some business segments that just are not going to be able to get back to their pre-February 15th situation by December 31st. It's like what Stuart said. It's all new, employment's all new, business levels, who knows if everybody's going to be able to come back or not, which is another reason why I think this summit that you all have started is important, because small businesses need the ability to get out there and talk to other small businesses and other professionals and ask the questions of, I want to continue, what kind of suggestions do you have for me? So that kind of gives you some modifications for PPP loans. I'm going to turn it over to Matt, and he's going to give us some guidance on PPP loan forgiveness.
Hello, everyone. My name is Matt Hagan. I'm a newer staff accountant here at Strothman. Definitely excited to be part of this team in this meeting. So thank you very much. I'm going to talk to you a little bit about the different aspects and categories of loan forgiveness. So the first category are the non-owner employees. And as Joyce mentioned, there are 2 different time frames, the 8-week covered period and then the longer 24-week covered period. The 8-week period covers a maximum of $15,385, while the longer 24-week period covers a maximum of $46,154. The next category consists of the owner employees, the self-employed, and the general partners. Now, the limits for this class are a little different. The 8-week period covers a maximum of the lesser of $15,385, or the equivalent of 8 weeks of your 2019 compensation. Meanwhile, the 24-week period covers the maximum of the lesser of either $20,833 or 2.5 months of your 2019 compensation. Now, on August 24th of this year, SBA clarified that stakeholders with a less than 5% share in a C Corp or S Corp are not subject to the owner-employee compensation maximums. This means they're now eligible for the full $46,154 of the longer 24-week covered period. Partners, however, will still be subject to the $20,833 limit. So now let's take a look at non-cash compensation and what all that consists of. So this includes group health costs. This is going to be your health, dental, vision, and these are paid during the covered period for coverage during the covered period. Now, unfortunately, these are not allowable for those S Corp owners and family members who have a greater than 2% interest in the business, self-employed individuals, or general partners. Another thing to note, retirement benefits cannot be accelerated outside of the covered period. State and local unemployment taxes are another area of covered non-cash compensation. So Joyce spoke of the 60-40 rule. So let's take a look at the 40% category, and that is going to be the non-payroll cost. So interest on mortgages that were in place prior to February the 15th would be one such cost. Another would be rent under a lease that was enforced before February the 15th, or if the lease was renewed before then. Utilities for which service began before February the 15th. Electric, gas, water, telephone and internet, even transportation fall under the heading of non-payroll costs that the PPP loans cover. The timing of the costs can be a bit confusing, so let me just try to clarify it a little bit there. The PPP loan pays for costs that were incurred before the covered period and paid during the covered period, and those costs incurred during the covered period and paid after the covered period, but on or before the next regular pay date. Now, a couple of notable exceptions to this are the employee group health benefits and accelerated retirement benefits. So hopefully that clears things up just a bit. Now, with the extension to the 24-week period, most borrowers are going to be expected to achieve 100% loan forgiveness. Borrowers can submit forgiveness applications at any time, even before the end of the covered period, if all funds have been exhausted. A couple of important points to note: early applicants must account for wage reductions in excess of 25% through the end of their covered period, and early applicants do not need to account for subsequent FTE reductions. Now, for loans not reviewed by the SBA, and those are going to be the ones less than $2 million, the lender has 60 days from receipt of completed application to issue a decision to the SBA. After that, the SBA has 90 days to render a decision to the lender regarding forgiveness. Now, please note, it is important that borrowers retain all documentation for 6 years after the loan is forgiven or repaid in full. So thank you for your time. I'm now going to turn it over to Chantelle, who's going to speak to you about the taxability of loan forgiveness.
Hello, as Matt said, my name is Chantelle, and I'm going to talk to you about the potential taxability of your PPP loans. Okay, so now when the loan was initially funded, that was not taxable income to you because you had an obligation to repay that loan, and loan proceeds are never taxable income. However, when that loan or a part thereof is forgiven by a lender, it becomes cancellation of debt income or COD income, which is typically taxable. And this is true of most loan or debt obligations. If the lender forgives all or a portion of your loan, you usually have to recognize that amount in your taxable income. And with the PPP loan, our goal, of course, is 100% forgiveness, which in turn generates COD income. Now, the authors of the CARES Act were aware of this treatment. And so in an effort to avoid PPP loan forgiveness from becoming taxable COD income to the borrowers, the authors included specific language in that bill that spelled out that COD income on the forgiven PPP loans was not to be subject to tax. So perfect, our PPP loans are issued. This is great. We get to focus on paying our employees and hopefully keeping our businesses afloat. And the PPP Flexibility Act that Joyce discussed made forgiveness compliance threshold even easier on us by moving from an 8-week covered period to the 24 covered week period, and by reducing the amount required to be spent on payroll from 75% to 60%. So this is all good news for us. But what the CARES Act failed to do was discuss how do we treat those expenses that we are paying with our forgiven PPP loan. And this is where our friends at the IRS stepped in. The IRS read the language of the CARES Act bill and agreed. COD income generated by forgiveness of a PPP loan is indeed tax exempt income. You will not need to recognize it as income on your tax return. So far, so good. We have the IRS on our side so far. But remember, I mentioned that the CARES Act did not address the expenses paid with those forgiven PPP loans. Well, the IRS caught that. And so they issued notice 2020-32. And they said, okay, but remember, under the Internal Revenue, the Internal Revenue Code, expenses paid with tax exempt income are not deductible. So in other words, we won't tax you on the COD income, but we are going to disallow the expenses you paid in order to generate that loan forgiveness. So in short, that $100,000 of forgiven PPP monies that you spent on payroll, you don't have to report the $100,000 as COD income, but per the Internal Revenue Code, we're going to disallow the $100,000 of payroll expense that you paid to qualify you for that loan forgiveness. And the IRS stands behind their disallowance of expense position because in their eyes, if you don't pick it up as income, and you still get to deduct the expense, you are receiving a double tax benefit. And that is what the IRS is trying to prevent from happening with this notice. And the IRS cited various case law in Notice 2020-32 to demonstrate how that section of the code has been challenged unsuccessfully in the past. One such case was Manchio versus Commission. In that case, the taxpayer was a former Air Force pilot and was currently employed as a commercial pilot. The taxpayer took a flight training course, which was required in his line of work. And since he was a veteran, he was eligible for education assistance from the VA, which reimbursed him for 90% of his course. So his course cost roughly $4,200, and the VA reimbursed him about $3,800. Now, VA education assistance payments are tax exempt income. So Manchio did not record that $3,800 on his return as taxable income. However, as the training course was related to his line of work, it was a deductible expense. And so he claimed a deduction, but he claimed a deduction for the full cost of the course. So he claimed a $4,200 deduction on his return. Manchio argued that he had other taxable income as a pilot, excuse me, and that the expense of the course was tied to his taxable business income. The IRS argued that the expense was was allocable to his tax-exempt VA income because had he not incurred and completed the course, he would not have received the $3,800 reimbursement from the VA. So you can't have one without the other, then they must be tied. So needless to say, the IRS won in this case, and that is the position they are taking with the PPP loan forgiveness. In order to produce the COD income, you have to spend the PPP funds on specific qualified expenses like those Matt had discussed earlier, or you lose consideration for forgiveness. Because in order to have one, you must have the other. So now let's see how this works. So in our base case here, this is kind of a pre-COVID, pre-PPP world. A taxpayer would have $500 of income and $300 of expense and would report $200 of taxable income. Now, typically with loan forgiveness, we would move into the second column, the with COD income. And so here we have $500 still of income, but we're also recognizing $100 of COD income, and we still get to deduct our full expenses of $300, but it does increase our net income, obviously, by that $100 that we had to pick up. Now, the next column, this is what Congress intended with the CARES Act. We do not pick up COD income because that was specifically excluded in the CARES Act, and there should not be any impact on our expenses. So we're back to reporting that lower $200 level of income. Now, in the final column, this is what the IRS is presenting in Notice 2020-32. And here you'll notice we still only have $500 of income and no $100 of COD income. But now on the expense side of things, we have $300 of business expenses, and $100 of those expenses have been disallowed because they're allocable to tax-exempt income, which gets us back up to that higher $300 taxable income level. So $100 more than what was intended by the CARES Act. So no, it's not taxable income. It's an expense disallowance, but really it kind of feels like semantics at this point. Now, again, expense disallowance was not congressional intent, and many legislators have come out in opposition to this disallowance, and there's lots of lobbying going on to correct this treatment. In May, a bill, the Small Business Expense Protection Act of 2020, was introduced in Congress. And this bill seeks to expand the language in the CARES Act to specifically prevent this type of disallowance. So what's going to happen? The bill has a lot of congressional support. Senate Finance Committee Chairman Chuck Grassley, a Republican from Iowa, and House and Ways Means Committee Chairman Richard Neal, a Democrat from Massachusetts, have both taken issue with IRS Notice 2020-32. However, the bill has some strong detractors as well. Treasury Secretary Munchin has indicated that he supports Notice 2020-32 and has said the money coming in the PPP is not taxable. So if the money that's coming in is not taxable, you can't double dip. You can't say you're going to get deductions for workers that you didn't pay for. And he has gone on to say that this is basically tax 101. It's a simple rule. So what will happen? Honestly, we don't know. We just know that it does not appear to be an easy guaranteed fix that we can count on at this point. So where does that leave us? As it currently stands, expenses paid with forgiven PPP loan proceeds are not deductible. And absent further action, we anticipate that the expense disallowance will impact your 2020 tax return. So assuming you're a calendar year taxpayer, these expenses will be disallowed on the return that you'll file in March or April of next year. So for now, we're recommending that you consider the impact on your taxable income when making your estimate payments. If resolution is not achieved by early next year, you may want to consider extending your return. That will allow you to see where the dice land before filing. However, again, in an effort to avoid penalties and interest, I would encourage you to plan for the worst case and assume it will be taxable, and then hope that that doesn't come true. If nothing more than just so that you have adequate cash flow resources available for you. Another option is you can take a position and file your return. And then if that position holds true, great. But if not, you're going to have to amend your return. And keep in mind, if you're operating as a pass-through entity, amendment will mean your pass-through business return will be amended along with your individual return and the returns of your business partners. So I would strongly recommend talking to your tax advisor to help you plan accordingly. Now, in regards to this expense disallowance, I want to share with you a little benefit that impacts self-employed individuals and general partners in a partnership, those subject to SC tax. If you fall into that category, I'm sure you're well aware, the PPP loan and forgiveness applications allowed self-employed individuals to include owner compensation replacement to be included in the covered expenses. So here's where the benefit comes in. Self-employed individuals, when they pay themselves, that's a draw. It is not a deductible expense on their Schedule C. Likewise, a general partner outside of guaranteed payments, if they receive a distribution from their partnership, it is not taxable income to the partner, nor is it a deductible expense by the partnership. So self-employed individuals and general partners do not have an expense to be offset for the amount of their owner compensation replacement, which was mentioned earlier, could be as high as $15,385 or $20,833 based on your covered period. So these individuals will realize tax-free income with no expense disallowance. But please keep in mind, this is only the owner compensation replacement. It does not apply to the payroll costs of any non-owner employees on your payroll. And so now I'm going to turn things back over to Joyce, and she is going to talk about the future of loan forgiveness.
Okay, what we are hopeful for and what we've been promised, but it hasn't happened, and I think they're all going to be out on the campaign trail soon. We're hoping for an even simpler application for smaller PPP loans, those that are under 150,000. What would be ideal is if we really get the automatic forgiveness that has been talked about for loans again under 150,000. The key to this 150,000 is what we talked about earlier. It would account for 86% of the total PPP loans that were issued, but it would be less than 26% of the 500 and something billion dollars, I think it was $1 billion worth of PPP loan dollars. So that's where, when you hear this 120,000, that's where that's coming from. Before Congress broke for summer break, there were hot and heavy discussions about this, but I'm not sure that it's really picked up after that. There is money that's available. There may be a second PPP loan program, but we're not sure about that either. You know, Chantelle talked about the Small Business Expense Protection Act. We're hoping to see that ratified. There are still so many questions related to that. If it were ratified, then your expenses that you used your PPP loan money for, you would be able to deduct those. We still have to have clarification on when the expenses are really going to be considered non-deductible. Chantelle gave you the conservative approach. If basically the IRS is saying, if you receive loan proceeds in your fiscal or your calendar year 2020, then expenses during that same year would be considered non-deductible. But there's been discussion of, what if you don't know what your end of your covered period, you have 10 months to apply for loan forgiveness. Let's say that puts that into the middle of next year, which is a new taxable year for you. You don't know if your loan's going to be forgiven. You might want to take the stance that you shouldn't have to be disallowed your expense deduction until you know that. So it really is still up in the air. And for all of us that have been on this PPP journey since the end of March, things were coming out. Sometimes things would come out after we left work at night and it'd be there the next morning from the SBA. And I know the bankers involved here know that. And you know, you small business people that were trying to apply for loans and it kept changing on you as to what you had to provide. There is just so much that's left up in the air. I guess our best advice is stay tuned. So we appreciate being here with you. And that's the end of our formal presentation. We'll be glad to try to answer questions, or if there's something we can't answer for you, we'll definitely get your contact information so that we can get back with you.
Awesome. Thanks so much, guys. Really, that was awesome. So now what we'll go ahead and do is we'll open up the discussion for a Q&A. So if you guys have any questions, feel free to ask. And I'll also be checking on Facebook as well to see if there's any questions on there. See if I can. I guess I have a question more so related to the percentages of that you were discussing, for one being for PPP, I mean payroll, and the other being for allowed expenses. How exactly is that rule structured? So I'm assuming, let's say you don't account 100% or 80 or 60% for payroll, for example. Let's say you allocate 50% of the loan that you took out to payroll expenses and the rest to other allowable expenses. How exactly is the forgiveness work in that scenario, or is it completely off the table?
No, it'll be in the, I don't think there's a cliff. I think they took the cliff away so that if you achieve 50% when you go through your loan application, you will still get forgiveness. I don't think there used to be a cliff where with the 75-25, if you didn't meet the 75%, you wouldn't get anything. So when you work through the loan application, it's going to prorate it for you on what you're going to be able to be forgiven.
Yeah, I'm curious if some members of the audience have had PPP loans and maybe talk a little bit about their experience with it thus far. I don't know if anyone is. Let's see. Check on Facebook as well. Okay. So let me check the chat as well just to make sure. Yeah, it looks like there's not too many questions related to that. I mean, there was a ton of information there, so I'm sure you answered a lot of questions that probably people had outstanding about the PPP process. So I really do appreciate that. Anything else that you think overall that you maybe didn't cover that would be pertinent to for people to know about?
I don't think so, but I do want, we will be available. If someone would have a request for information, you all are more than welcome to give us to give them our contact information, and we'll be glad to try to help out. As we all said before, our purpose here is what can we all do for small businesses, because we're all hurting.
Yeah, of course. Like I said at the beginning of this meeting, this will be recorded, so we will include all your guys' information in the show notes for YouTube and whatever social platforms we share this on as well. So, and yeah, if any one of you in the audience or on Facebook want clarification on certain things, feel free to reach out. Be happy to share that contact information with you. Cool. Do you guys have anything else before rounding out this inaugural meeting? No one else? Awesome. Well, thanks again for everyone who attended. Like we said, we're going to try to do these quarterly, and we really try to bring on experts to talk about various topics that are pertinent to business owners. So hopefully, if you know business owners in the area, feel free to invite them. And I think long term, once we actually can start meeting in person, it's going to be a really good opportunity for everyone to network and grow their businesses together. So really excited to help in any way we can.
Thank you, guys.
Thanks, guys.
Thank
Thank
you.
Take it easy. We'll see ya.